high yield bond ETF. First off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. So we go here to fixed income and we will look at corporate bonds, and that is the high yield corporate bonds ETF. The HYG is the ticker. 5% here from the low and around a 1% pullback. Okay, so let's jump into the charts. We do have something that looks a bit like time cycles here, some smaller, but you could also argue that there might be some bigger as well. Okay, so if we zoom in a bit here, and these are weekly data points, we are testing here this green 50-week moving average. So like this and this. So this is a very important moving average, and we did also have a bit of a golden cross here. So yeah, we are seeing some support come in. When we go here to the daily data points, then we have the super important red 200-day moving average. Blue arrows show that it has a strong tendency to offer support, but the pink arrows show that when it becomes resistance, things can get really bad. So this is it's a very important moving average. We are testing it now. And if we zoom in a bit, we do see that on Friday, the buyers came in here and bought quite aggressively when we were below that moving average. That's interesting. We did test it a couple times back here, and then we eventually got a nice rally. So the primary thesis would be that that moving average will continue to offer support. When we jump here and look at the other technical indicators here on the weekly data points, the RSI has currently reached a level. I mean, it is pretty clear that the current level right here and right now, it does have a tendency here to form lows. At least that was the narrative here, and here, and also here. We did at least get a bounce or a bigger rally. When we jump to the daily data points, yeah, accumulation distribution is rather strong, so there definitely are buyers. Yeah, I think this overall this looks interesting. When we go here to the statistical correlations, so long-term weekly data points, 55-ish here with the S&P 500. We have a minus 26-ish% negative here with the 20-year Treasury bond ETF. Jumping to the daily data points, then we have a 71% positive correlation with the 20-year Treasury bonds, and an 80% positive here with the S&P 500. And the high yield bonds, they are viewed as being like more risk, but potentially better reward. So this is the seasonality. Over the last 5 years, we do tend to see a bit of a weakness here into November, but then December is strong. Over the last 10 years, then we do see that from September to October, it is definitively an increase in strength here. So October is one of the stronger months, though November is a bit messy. Though December, January, and February are decent. And when we look at all the data, then there is a clear increase in strength from August into October, and this is October, so that is beneficial for the bulls. The problem is November. So November is the weakest month. Then again, December is one of the strongest months, so the seasonality here is a bit messy. But the seasonality suggests that there's an increased probability of a bounce in October, but maybe it could be a good idea to take profits before November because of the seasonality. Okay. So here's Finviz. Let's see if they find some patterns. Yeah, we have support here at a diagonal trend line. So that's interesting. That supports a bullish thesis. When we compare the high yield bond ETF to the 20-year Treasury bond ETF, the TLT, we do see that looking at the year-to-date performance, it's been significantly weaker here for the TLT. Looking here at the yield, it is 4.31% here for the high yield ETF, substantially higher than the 1.5 you get here for the TLT. So yeah, definitely a significant divergence. So when we do the math on the dividend yield difference, it's 187% higher yield for the high yield ETF. So yeah, to sum up my take here for this ETF, I think that, could make the bullish case is simply too loud. We do have moving average support. The RSI also is at a level that has a strong tendency to be bought. The seasonality is supportive of a more bullish thesis. The big caveat is that when the 200-day moving average becomes resistance, that's when, the shit hits the fan. So definitively, we do want and we must see that strength comes in here. It is somewhat unfortunate that we did test that moving average multiple times quite recently. As we saw here, we did test it in August, actually 2 times. We did get that rally. But ideally, you do want to see strength come in a bit quicker than that. So it also looks here, it seems like this, there are some smaller time cycles here. So let's measure a bit. Yeah, approximately like, yeah, here there are some kind of time cycles. Not surgical, but it's rare to find, surgical time cycles. Okay. So whatever you do in this market, you want to let the trend be your friend. But the key thing here is to look at the trend in a bigger picture, because the issue with the slogan, let the trend be your friend, is that what does that mean? What kind of time frame are you looking at? And the most important thing is to look at the big picture. Because if you think that letting the trend be your friend is to look at the last 2 candlesticks, then that is not necessarily the big trend for that stock. So if you look at other indicators, and let's say that they tell you that the current setup is extremely rare, and the prior times it happened, looking back, like, let's say 20 years, something bad or something good happened, then that is like the key trend, not the latest candlesticks. Okay,